Everybody. Again, I hope everyone had a good Thanksgiving. It's nice to see you all. We are hosting our annual, if you will, we do Social Security and Medicare seminar every year. This is the first one, the Social Security. I'll put something up at the end, but we have our Medicare seminar coming up next week, next Wednesday at 11:30. Also with our friends at MFS. So they've been kind to help us out this year. But again, today's the Social Security seminar, and I'd like to introduce Zach Lindsay from MFS. He is a defined contribution consultant at MFS. And in his role, he informs advisors and analysts about the investment products at MFS and helps teach partners and clients like us things about Social Security and all the other fun topics out there. So, Zach, we're going to turn it over to you for about half hour, 35
Yeah,
minutes
give
or
or take,
so?
give or take 5 minutes. Yeah.
Okay. And then would you like people to hold questions till the end, or do you want them to chime in if they have them on the chat?
Um,
Or
to be honest, we're a pretty close group here, it looks like. So I would say if somebody has a question, I would never be offended if you come off mute and say, "Hey, Zach, shut your mouth for a second and explain that in more detail." So please, yeah, if people have some questions, feel free to stop me in my tracks.
Great. And if you aren't on mute, why don't you go ahead and put yourself on mute just so the background noise is limited? That would be great. All right. Go ahead, Zach. Take it away.
Yeah, appreciate it, Abby. And of course, thank you for teeing us up. We value that relationship. For everyone on the call, MFS, we're an asset management company, but as Abby kind of read off that kind of scripted LinkedIn description of my day to day, the best part of my job is right here, right? I feel like I found a little bit of a passion in some of these harder, nuanced topics for education purposes, and I feel like I definitely make more of an impact delivering this than telling Abby about all the great products that we have at MFS. So I thank you guys for using us for this, and of course we value that relationship. Um, the common feedback that I always get is if I can candidly open up, who I am and how I got involved in this, is the number one feedback I get when I do these types of seminars is surprise, surprise, people don't come up to me and ask Social Security questions. They come up to me and say, "What's some 30-year-old dude doing lecturing the topic of Social Security?" So, if everyone wants to know, I got involved because of my personal family. 3 years ago, my aunt and uncle filed for their benefit. They were both union. My uncle was an electrician, and my aunt was a nurse, and they both at 62 filed for their benefits, started that Social Security benefit right away, and then ultimately subjected themselves to something called the earnings limit or that earnings test, which we will cover today. And they went to me since none of my other family members were finance people in the family. And I had nothing but a shoulder shrug back at the time. So I knew fast forwarding to 2 years later, last year in 2024, that my own parents would be filing for their benefit. And 3 years ago at that time, I said, "Hey, I should probably take this upon myself to learn if I'm going to be a continued help to the family, near, extended, and then, friends of the future." So if you find yourself not immediately about to file, I just want to make sure you're aware that, this information might apply to you as far as you extending that help of that information to a family member or close friend. So with that, we can get started with the slide deck here. So I'm going to share my screen, and Abby, if you just don't mind, let me know once you see my first slide.
I can see it.
Perfect. So the way I like to usually start off these seminars is a little bit of a recency bias, right? We see Social Security in the headlines a little bit of as of late recency of this year. So I want to make sure people are aware about what's going on. First thing, I know it's over. Thank God it's over. The government shutdown, right? We had a ton of questions that came in during the government shutdown just asking, "Hey, what is the effect on this with Social Security?" And for everyone that wants to know, and even in the future for future shutdowns, because I'm sure more will occur, Social Security is deemed an essential line of business in the government. So payments continue, edits to your account, like your bank account where the deposits are going to, or your address where the checks are being sent to, all of that can continue to be changed during a government shutdown. And again, payments continue. The next thing I want to quickly address when it comes to recency and about what's going on is the Fairness Act. Okay, this was signed into law January 5th. It was one of the last things Biden signed in before leaving office of this year. And it's all good news for the majority of the people. Maybe not the accountants out there that are thinking about the insolvency of the trust fund, but for everyone else, it's great news because it means more money in your pocket. Now, I'm not going to go crazy into the weeds about the Fairness Act because out of 100% of the population collecting their benefit, it's only affecting 3% of that. So, but I do want to make sure that if anyone on the call feels like they may be affected, what's going on with it and how they were affected. So, on your screen, Fairness Act, it repealed both the WEP provision and the GPO provision. And then, based on those two repeals of those provisions, if you were affected by any of those two, it would have retroacted your benefits back to January 24 as well for a lump sum payment. Now, those that would have been affected by either this WEP or GPO provisions that have now been repealed have been 9 times out of 10, if not all cases, those that had a non-covered pension, which is majority of the time government employees. Okay, so think teachers, firefighters, police, first responders, state, municipal covered employees. And that non-covered pension, if you would have been affected, is just a fancy way of saying instead of your employer, in this case, the government or an entity of such, instead of them withholding payroll taxes to pay into the Social Security Trust Fund, they withheld those taxes to pay into a sponsored public pension instead. And then to see the monetary impacts, they would have said, all right, due to the size of your pension, we're either going to reduce your personal benefit, which is the WEP on the left, due to that size of the pension, okay? Or on the right, we're going to reduce the benefits off of a spouse, whether that's spousal if they're still alive or survivor if they passed away, due to the size of that pension. And as you can see, some of the monetary amounts on the right-hand side are a little bit larger. So I will say, if anyone's on the call that think they would be affected, we can always address you personally in Q&A after we're done the seminar. But to those that have family members or friends that may have been affected, just know that if you are in the Social Security system, you're fine. Okay, it's an auto adjustment. You're going to be fixed. But if those chose not to file, maybe because the math, the calculator, the advice they received said, hey, because of the size of your pension, you're not going to get any benefits from Social Security anyway. Why file? And that was the reason they chose not to. Those are the people that should be calling Social Security today because you're not in the system, so they don't know they need to fix you, right? So there's money on the table there for those people. But again, not to get crazy into the weeds of this Fairness Act, if you have questions about either if you, family member, or close friend were affected, just hit me up in questions after this seminar and we can always address that. Now, the way normal people, and I'm excluding myself from that scenario, the way most normal people get involved in Social Security is they're either going to receive their statement in the mail for the first time, which typically happens about 10 years prior to their first claiming age. So think ages of 50 to 52, you're going to get that statement in the mail for the first time. Or maybe you logged onto your account, right, on SSA.gov, which I will tell everyone, if you have a single year paid into Social Security, I recommend establishing an account and logging online. Okay, there's 2 separate login methods on SSA.gov that you can choose from. Just know, regardless of which login you use, you're going to get to that information you need from Social Security. Okay, and my recommendation for all is when you get onto your online account, whip out that calculator, have some fun. Okay, we're going to figure out how to figure out your average and that PIA, the amount you're going to get at your full retirement age, and how to determine that. But play with the math. Right? We always joke with friends and family about how often government messes things up. So why not audit them yourself, right? Play with the math on your benefit, figure out if everything they're calculating is correct. Because I can tell you right now that you're going to organically or naturally understand your benefit picture that much more the more you look into your account and play with the math. Okay. And I'm all for self-educating. I'm all for making yourself feel more comfortable in the knowledge you have in your own benefit, right? What we feel, though, is most commonly skipped over, which is what we cherry picked in the top right-hand corner of your screen, is that your benefits are not intended to be your only source of income when you retire. Okay. So for everyone on the call today, your puzzle is going to contain different pieces, right? Some of you may have IRAs, traditional Roths. Some of you may have 401ks, whether that's traditional Roth sponsored 401ks. Maybe you have multiple of those 401ks from past employers. Maybe some of you have major assets like a second home you're planning on selling to help fund that fund in retirement, or rental property income, right? That passive stream. Regardless, everyone on the call situation is going to be unique. We always recommend meeting with your advisor team, the great people here at Euclid that brought us all together today, to understand how all these are going to come into your overall holistic approach to post-retirement income. We commonly say that your Social Security benefits is that one leg of the 3-legged stool. The other 66% right? The other two legs are important to be aware of and will honestly determine when it's best for you to claim that benefit. Okay. So as we go into the agenda of what we're covering today, it's a lot. Okay, we're going to go over a lot, and I'm not going to be that parent that finally tells the child that you can finally be selective in your hearing. But overall, is everything we're going to cover today going to apply to everyone? Probably not, right? However, as we make our way through, I did label 5 key gold slides that I will make known when we get to them, because I feel like, above all else, those 5 slides are going to apply to most, if not everyone, and will help us put our best foot forward as we go to plan to take that benefit. Okay. And as you see on your screen, we are going to talk about your own benefit, how you become eligible, how it's calculated, and then we're going to uniform that discussion over each benefit. So spousal, survivor, divorce, and then we're going to end with everyone's favorite topic to talk about and ask questions on, which is taxes and the roles that taxes play when it comes to your Social Security benefit. So first off, selfishly thinking, your own benefit, right? How do we work out and determine your eligibility and the important things to understand when it comes to your own? So first off, right away, our first key gold slide, know your full retirement age. This is going to be a lot easier in a couple years in 2027 once everyone's full retirement age is finally 67. But as you can see, depending on your date of birth, you might have a different full retirement age than 67. And as you can see, between certain birth years, there's that 2-month increments as it gets to a later birth year. Now, I typically ask everyone in the room, if I'm in a live setting, to either raise your hand or voice out. We don't have to do that in a virtual setting because I'll just let you know. But I ask people, excuse me, when's the last time you think the full retirement age was changed? And again, I'll tell you, it was 1983 during the Reagan administration, right? So over 40 years ago. But as you can see, there are still people grandfathered in to that in-between rule change. Okay. So for those of you in the call today that might be thinking, is this even worth knowing? Will Social Security even be there, right, when I need it, when I go to take it 10, 15, 17, 20 years from now? And I can tell you that although insolvency is estimated in the early or mid 2030s, right? I think 2034 right now is the year of the estimated insolvency date for the trust fund. Just know that Congress, as we all know, infamously will not pick up the pen to make changes until they absolutely have to, right? So if there are changes to be made over the next 8, 9 years to help with this insolvency issue, I would rest assured that they're going to grandfather in a large demographic. Most importantly, they're probably going to grandfather in the voting demographic, right? The largest voting demographic in the United States is 50 and older. So I'd be very confident today to say, if you are 50 and older right now, the rules for taking your benefit, if changed, you're going to be grandfathered into something along the lines of what you're planning on today. Okay. Because as we see, based on the last time they made changes to help with insolvency in 1983, a lot of the headlines in the late 70s and early 80s look exactly like they do today, right? If you want to have a fun little research, go to your local library, look up some of those papers and headlines from those dates, and you're going to see threatening language like you see today, right? Insolvency is going, or insolvency is coming, Social Security benefits are going away. And this is one of those things that I feel like might be justifiable for them to change, right? Life expectancy, we're living longer than we did in the early 80s. But again, soften that pillow. If you're 50 and older, they're going to grandfather you in, or else they're probably going to lose your vote, right? So for those of you that have that concern, hopefully, again, that makes that thought process a little bit more ease of thinking. And just so you know and are aware, for your full retirement age benefit, that amount you get at full retirement age is called PIA, your primary insurance amount. And there's a lot of calculations based off that number. Okay, so that's why we always want to figure out first, what is our full retirement age? The second thing we can look at is eligibility, right? So right there at the top of your screen, to qualify for Social Security benefits, you do need 40 quarters, essentially 10 years of earned income paying into the trust fund, right? And then to figure out that PIA, or that number you get at your full retirement age, they're going to then average out your 35 highest years of work. So 10 years to be eligible, 35-year average. If you don't have 35 years total, just know zeros will go into your average, okay? Then, as we look at the bar charts, most of us, again, are going to be on the right-hand side with full retirement age 67. But then we can see the pluses and minuses claiming before or after your FRA age, okay? Just know, claiming any benefit before you turn that full retirement age means that your benefits will be permanently reduced, okay? Claiming any benefit at or after your full retirement age, as you see, they will grow 8% year over year and become maximized at age 70. Those growth percentages are in addition to any cost of living adjustment or COLA adjustment, which is what Social Security calls that adjustment for inflation. Okay. Now, a common question that I usually get when I go over pluses and minuses is, Zach, why don't I just take my benefit right away at 62? I have great advisors here, Abby, Casey, and the team at Euclid to invest those assets. And I can probably get more from the stock market or total return if I just take right away and invest versus letting it grow naturally in the trust fund. Now, I will say for everyone that has this question, no matter who you are and what situation you're in, always going to be unique. It's always going to be case by case if it allows you to make that decision. So important questions that we always ask for people planning on taking their benefit early. Are you working? Right? What's your marriage status? What's your life expectancy? Your health status, right? All of these are going to factor, including your outside accounts and investment vehicles you have elsewhere, into when it's best to claim your benefit. But if we're going to try to extrapolate data or research that's done on that question, it's even more of a case of unique, right? And what I mean by that is the Journal of Financial Planning is the research shop that asks that question every year. They just kind of reframe their data set to give you a different frame of thought. 2023, they went back 100 years of market returns and they said, what's best? Take it right away at 62, max at 70. How much do you get from a total return and what's the best decision there? Going over 100 years of market returns, they found in 80% of all cases, it's actually best to let it grow naturally in the trust fund. I'm sure Abby, Casey, and the team here at Euclid can speak to you when they're looking at 100 years, how hard it actually is to beat that natural 8%, given that long of a track record. But then in 2024, the same research shop asked the same question, but instead of looking back 100 years of market returns, they look back 15 years. And again, our advisors on the call today can probably attest that the last 15 years of the stock market is pretty unprecedented when it comes to the last 100 years. Because in the last 15 years of market returns, they said, actually, it's best to just take it right away and invest those assets instead. So again, that just tells me, because they're contradicting themselves within 13 months of what's best to do, there's never going to be a one shoe size fits all for everyone. Always going to be case by case. Always best to consult your advisor for all those different questions and scenarios to find out what's best for you individually. So let's find out why we asked that question first. Are you working? And this is our second key gold slide. This is the slide that we can all thank my aunt and uncle's mistakes for why I'm here today, because this is that earnings limit and that earnings test. So essentially, Social Security calls that earnings limit as a way of saying that there's a limit to how much you can earn while collecting your benefit under full retirement age before your benefits are withheld from you. Okay. Now, looking at those bullet points at the bottom, they're only going to look at gross wages, right? So unearned income, pension, IRA, rental property income, not included on this. We commonly say if it's not on a 1099, if it's not on a W-2, most likely not part of the earnings limit. Okay. The second part is that it's only going to look at the individual taking their benefit. So regardless of you and your spouse's joint filing status with the IRS, you taking your benefit, only going to look at your individual earnings. Okay. And then thirdly, it's only going to affect you if you turn your benefit on before full retirement age. Once you turn full retirement age, rip up this page like your dog did your sixth grade homework. Social Security will not care how much money you make while collecting your benefit after you turn full retirement age. But it's exactly why things like this is why we ask, are you working, for anyone planning to take their benefit earlier than full retirement age? And it's really because the way the withholding works. The way the withholding works is it's not dollars on checks, it's numbers of checks that they withhold. Some people think it's dollars on checks, so they're like, oh, I'm going to make a little bit over the limit. That's fine. I'll just see $50 off each check for the whole year, and I'll take that on the chin. When in reality, they start going over the limit, they might get 1, 2, 3, 4 months in a row without getting a check at all. Okay. So that's exactly why we always ask this question first and why it's important to be aware for anyone planning on taking their benefit before full retirement age. So now that we addressed your own benefit eligibility calculation and that common mistake or catch up there, let's go over that same kind of uniform approach when we talk spousal and survivor. So Social Security does offer something called spousal benefits, right? Even if you've never worked, you could be entitled to up to 50% of your spouse's benefit at full retirement age. Okay. Keeping this discussion the same, let's start with eligibility. Okay. How do I know I'm eligible for spousal benefit? Three major requirements. I'm sure most of us can probably guess the first one, which is you have to be married, right? And then that length of marriage rule says that you have to be married for at least 1 year when you go to claim the spousal benefit. Okay. The second rule is your spouse must also be collecting their benefit to get one off them. And then the third is you have to be 62 or older. Now, there are some exceptions to that age limit. Can always address those, if any, with questions. Okay. Now that we worked out you're eligible, how do we then calculate that benefit? Well, remember that first key gold side? I said know what your full retirement age and then that benefit you get at that full retirement age. Well, if you happen to be sitting next to your significant other, now's the opportunity to give them a little nudge or a knee on the side and say, hey, were you paying attention? Because the amount of the spousal benefit off the spouse is always, in all scenarios, based on whatever they're getting at full retirement age or their PIA. Okay. We take that amount and then we multiply it by the age we are when we file and claim that spousal benefit off our spouse. And you can see those percentages that correspond with the ages across your screen now. Okay. But a couple things to note there is that both you and your spouse worked, right? You can no longer start with your own or a spousal and then switch to the other. Okay. That was prior called file and suspend. Social Security got rid of that option. And now this is the first year everyone's grandfathered out of that option. So now technically when you file, you are filing for whichever is higher. You're only entitled to one benefit at a time, but it's always the highest benefit you're entitled to. You're going to get the higher of either your benefit, if eligible, at your age and percentage, or the spousal off your spouse, right? If eligible at your age or percentage. Okay. And you can't switch anymore. Okay. And then additionally, divorce benefits are calculated the same way, but there are some differences in eligibility that we're going to cover briefly in questions. So now let's try to draw this out in a little case study or hypothetical to try to bring it a little bit more light. So here, some of the names might seem familiar. We have a little ditty about Jack and Diane, right? Two American kids growing up in the heartland. Summer is well over. John Mellencamp is for the summer months, so no, I will not sing the song, but we can always put that on hold until April next year. So here, the little twist that we're going to throw on this story or the song is Diane is going to be the star athlete. She's the higher earner. And then Jack is going to be that Butillion, which is just a male's version of a debutante. So what we want to know is what is Jack's maximum and minimum spousal benefit off of Diane based off of different claiming ages for both. Okay. So on the left, we see Diane's own benefit based on the different ages she claims her own benefit. In the middle, we see Jack's minimum off of Diane if he claimed earliest at 62. And then on the right, we see Jack's maximum spousal benefit off Diane if he waited and maxed out his spousal percentage at 67. And as you can see, no matter when Diane claims her own benefit, since the spousal offer is always, in all scenarios, based off her PIA or full retirement age number, the 10,000, Jack's spousal off of her will then always be determined by his age that he chooses to file that. Okay. But remember eligibility requirements. In this case, Diane has to be collecting hers for Jack to get one offer. So let's throw another twist and say, well, what if Jack claims his own smaller benefit first and then Diane files years later? What happens is Social Security does this top off or what they call the excess spousal benefit equation. They take the full 50% that Jack could have gotten. They then minus from that number whatever Jack's full retirement age benefit is, and then whatever's left over, if any, is added on to whatever Jack is currently receiving. Because remember, he files first. Now, I usually lose some people in the room, right, when I go over this excess spousal equation, so don't worry. We have another case study to bring it more light. So here is our ABC hypothetical, our Alex, Blake, and Chris. They're all 62. They're all married. They're all retired, and they're all taking their benefit. What they want to know is, what am I going to start with now? And then what am I going to get once my higher earner spouse applies? Okay. So I want to populate all three scenarios. I know there's a lot on your screen to look at. What I really just want you to pay attention to is the gray bars up top. That's the excess spousal math that we just went over. The blue is what they start with. The green is what they end up with. Okay. So on Chris on the left, you can see not available for his own retirement benefit. So this is a very traditional way of thinking spousal because Chris's only option is the spousal benefit. Chris, as we see in the green bar, he's 67 or full retirement age when that spousal kicks on. So he gets the full 50%, the $1,200. But again, that's not usually how the real world scenarios works out. What's most close to real world scenarios is Blake in the middle. So Blake, as you can see, full retirement age benefit up top is $1,000. But as we see in the blue bar, Blake starts with his early. 62 gets a 30% reduction from that full retirement age number. So he's going to start with $700 a month. Fast forward 5 years later. Okay. Blake's higher earner spouse applies for their benefit. Now they're going to do that excess spousal benefit math, which we then look at the gray bar for Blake. The 1,200 minus 1,000 gives us $200 left over, which is then added on to Blake's 700. And then Blake goes from 700 a month to now 900 a month once the higher earner spouse applies. So remember when I said if you claim for your benefit before full retirement age, your benefits are permanently reduced. This is the proof of the pudding there. Just because Blake is full retirement age when the higher earner spouse applies doesn't mean Blake gets the full 50%. Because Blake started with theirs early, they just get that top off going from 700 to 900 instead of 700 to 1,200. Okay. And then we look at Alex on the right, which starts the exact same way as Blake. But then once Alex's higher earner spouse applies, as we see at the top, 1,000 minus 1,000 is zero. So unfortunately for Alex, their spouse is not as rich or making as much money as Blake's spouse, so they don't get a top off. Okay. So take a quick look at the three scenarios and just see which one may align to you the most. And again, if you're looking at Blake and already trying to whip out the calculator and go through all those ifs and thens based on when you and your spouse may apply, I ask you not to focus on all the ifs and thens. What I want you to focus on is that Social Security claiming should never be just a straight up me decision. Okay. To max out the total between you and your spouse and how much you're going to get from Social Security over both your lives, it should always be treated as a we conversation. And when you're approaching your advisors here at Euclid and understanding what's best to do between you and your spouse, have both statements available to them. That's the only way Abby, Casey, and the rest of that team there can make the proper calls or decision or advice for you to get the most from Social Security over both your lives. Okay. We want to make sure that you're putting the best foot forward to game plan the benefit and getting the most from the trust fund. And to do so always involves both statements and both spouses' decisions. Okay. So now let's move on to that survivor benefit. Okay. So in addition to the spousal, if you've ever been married, you could be also eligible for the survivor benefit. So again, keeping it uniform in the discussion, starting with eligibility. Two major requirements. Okay, to be eligible for the survivor benefit. Again, most of us can probably guess what the first one is, which is you had to have been married. Okay. And if you were married when your spouse passed away, the length of marriage rule says that you had to have been married for at least 9 months. Okay. But if you were divorced, okay, and you didn't remarry or you remarried after turning 60, the length of marriage rule states 10 consecutive years, okay, to retain the survivor benefit off of a divorced ex. All right. And then the second rule is you have to be 60 or older. Okay. Which again, there are exceptions to, which we can always address, if any, in questions. So then once we worked out you're eligible for the survivor benefit, how is it then calculated? Sort of similar how we dealt with the spousal. Okay. But the number we're basing it off of is slightly different. So the number we're basing the survivor benefit off of is either A, whatever the deceased was receiving at the time of death, or B, if they passed away before full retirement age and never claimed, then we're just jumping their number up to their full retirement age benefit. Okay. We then take that number and then similar to spousal, we're going to multiply from that number the percentage that corresponds with our age when we turn that benefit on. And as you see on your screen now, those percentages that correspond with each age. Okay. Three major rules, or I guess I should say four major rules that are different when it comes to survivor benefits versus spousal that I think are very important to address. The first one might be obvious. It's the percentages, right? Max spousal is 50%. Max survivor is 100%. Okay. The second is the age limit. right? Earliest age is 62 for your own and spousal. For survivor, they said, hey, you might have just lost half the wallet of the household. We'll give you an extra 2 years earlier to claim that benefit. So know the difference of eligibility of 62 for your own or spousal and 60 for that survivor. The third key difference is that to file for your own or spousal benefit, you can do so through either your online account or a phone appointment. For a survivor benefit, current rules state that you have to file for that in person, okay, at your local Social Security office. And the last and most important differentiator when it comes to survivor benefit that I think is crucial for everyone to be aware of is that remember when I said you can't start with your own or the spousal and switch? For the survivor benefit, you can switch. So in the scenario where you have a higher earner and a lower earner, if that lower earner were to pass away first, right, that higher earner can actually turn on the survivor benefit off that lower earner, start collecting that benefit while they continue to grow and maximize their own higher benefit till age 70 and then make the switch at that time. So I do want to show a couple examples here of that survivor benefit and the differences because I think it's important to emphasize. So first off here, this case study is looking at a higher and lower earner where we can see they both claimed at age 65. Okay. We fast forward 10 years, higher earner passes away. Since that lower earner is at least full retirement age or older, they can now switch and get 100% of what that deceased was receiving, going from that 1042 number they started with to now the 3125 once the higher earner passes away. Okay, so that ability to switch up. The next thing I want to emphasize, which is our third key gold side of the presentation, is our kind of general rule of thumb here for Social Security benefits is that you always, between two spouses, want to try to grow the higher earners benefit the most. If you can think about the way Social Security grows, it's a percentage based. So taking, say, a $3,000 benefit versus a $1,000 benefit, since they're both growing 8% year over year, that $3,000 benefit is going to grow that much more than the lower earners benefit. Okay. So we want to emphasize the growth and the decision of that higher earners benefit. And to prove that point here, let's pretend on your screen that blue and green are a married couple. Okay. And again, for the sake of our argument, let's say both took at 62. Blue's going to get 23,000 a year. Green's going to get 38,000 a year. If green were to pass away, as long as blue is full retirement age or older, they can go from that 23,000 a year to the 38,000 a year. Okay, and get 100% of what green was receiving. Now, if green waited and maximized their higher earner benefit till 70, that's going to now bear in mind the question, does an extra 21 grand a year make a difference to that surviving spouse? Where am I getting 21,000 from? Well, that's the difference in green's benefit from 62 versus 70. And if they waited to take at 70 and then passed away later on, green or blue would have the ability to go from 23,000 all the way up to 59,000 a year. Now, for the higher earners decision, again, we want to emphasize that for that reason, but I understand that by waiting to take your benefit at 70, you may not get all the benefits over your personal lifetime, but it does mean that you're doing everything you can through the lens of Social Security to protect your surviving spouse financially. And that alone might be worth that decision to wait till 70 to take your own benefit. Okay. So now that we address spousal and survivor, I do want to quickly address the divorcee benefit and how that works. So starting off with eligibility first, how do I know I'm eligible for a spousal benefit off of an ex? Two major rules, right? First one, again, you had to have been married at some point. And then that length of marriage rule states that you had to have been married for 10 consecutive years to retain that spousal and survivor benefit off the ex. Okay. The second rule, right, is that you have to be also 62 or older, just like it comes with your own or a spousal benefit as well. Okay. Then there's also something called a 2-year rule. And this is kind of a special rule when it comes to divorce benefits. The 2-year rule states that if the divorce was within the last 2 years, then it's just like spousal. You need your ex to be taking theirs to get one off them. If it's been beyond 2 years, they get rid of that rule. You don't need to wait for an ex to take theirs to get one off them. Okay. But what I really want to address to any divorcees on the call, or dare I say future divorcees, and you talk Social Security enough, you talk plenty of morbid scenarios like that. But what I really want to express or emphasize is the remarry rules. So traditionally, you remarry you're going to forfeit all the benefits off the X. But two exceptions to that. If you remarry after turning 60, you're actually going to retain that survivor benefit off the X. And remember, the survivor benefit is the bigger chunk, right? So if you're 58, you fall in new love, and you had a prior marriage that lasted 10 consecutive years, you may want to wait to drop the knee or wait to say yes to that spouse until you're at least age 60, right? Especially if your ex is richer than your newfound love. And then secondly, the next exception is if then that second marriage ends, and that can be through divorce, annulment, or death, you could become re-entitled to the benefits off the first marriage. So to show how that works, because I'm sure a bunch of us are now thinking in space how often they've been married in the past and how they can maximize all those prior marriages. Here we have Jane Fonda. She's probably set herself up better than anyone I've ever heard when it comes to Social Security benefits. As you can see, she was married to Tom Hayden up top, Ted Turner, or shown as Theo, on the bottom. Both marriages lasted at least 10 consecutive years. Both ended in divorce. Jane can only take one benefit, but it's always the highest she's entitled to, which can either be her own benefit, the survivor off Tom Hayden since he's passed away, or the spousal off Ted Turner while he's still alive. And then if Ted was ever to kick the bucket in the coming years, she could potentially switch to the survivor benefit off Ted Turner if it's higher than any of the current benefit she's collecting. Okay. So hopefully that clears up some of those questions about maximizing prior marriages. Now off to our final and favorite topic, which is taxes. So regardless of your age, once you start taking Social Security, your benefits may be taxable if your income exceeds 25,000 filing single or 32,000 married filing jointly. I know those numbers might seem small for tax filing purposes, but remember, when you're taking your Social Security benefit, you're not supposed to be working anymore, right? So that's kind of the intent on those lower numbers. And the good thing is, which it's rare you can say there's any good things when you talk taxes, is that if you see in the top right-hand corner, the max tax rate of your benefits is 85%. So current rules state that your Social Security benefits are not 100% taxable. Okay. Uncle Sam is at least going to provide that 15% cushion to what is owed. However, I get it. It's frustrating. You spent your whole life paying into the Social Security Trust Fund. Now, of course, it's being taxed on the way out. But from a non-CPA, a non-tax tax professional, my advice for everyone on how to approach taxes is use the GI Joe approach. What is the GI Joe approach? It's knowledge is half the battle. And as we commonly know, or maybe joke about, the more you know about taxes, the less you pay. And the more you know about that taxable equation, the more you're going to understand how to play defense on that liability. Excuse me. So let's look at the equation. To determine how much of your benefits could be added to your income and then thus become taxable, the government uses what's called combined income. And that's what's on your screen now. It's adjusted gross income plus tax-exempt income plus only half of your Social Security benefits. Okay. Now, there are some investment vehicles and other items that are not included in this combined income equation. It's important to understand what those vehicles are, because if you can rely and use some of those vehicles while letting Social Security grow in the background, and then Social Security ends up making up the majority of your post-retirement income, that can be a natural way to play defense on tax liability. And to show that, here's an example. This is our fourth key gold slide, because I think it emphasizes that point of letting Social Security grow, how it can be that one tool in your toolbox to help control taxes. So here we're looking at a couple. They have an after-tax income goal of 75K, and they're contemplating taking benefits at 62 on the left or 70 on the right. And if we look right there at that top row, if they wait till 70, majority of that 75 after tax goal is being made up of their Social Security benefit, which means in the second row, less has to be made up in the in-between from their withdrawal from tax deferred accounts, which means then we get to less of a combined income equation, which then ultimately, as we continue to work our way down, means less federal income tax liability. My big disclosure going over this slide is that it is a perfect hypothetical. What it's not meant to tell you is that by letting Social Security alone grow, that it can reduce your federal tax liability to zero. If it was that case, I'd be copy pasting the slide to everyone I know. What it's meant to do is that by letting Social Security grow, having it make up more of your post-retirement income goals, it can be one tool in your toolbox to, again, play defense on liability. I would always say for everyone trying to think about how to use Social Security and help with tax liability, consult a CPA, consult a qualified tax professional, and always talk about those game planning techniques with your advisor team here today. So briefly, I do want to cover and mention, as I said, there are some investment vehicles not included in that combined income equation. Some of those examples are on your screen now. Again, not going to go into the weeds for the sake of time, but quickly highlighting the Roth IRA box. Anyone that has access to a Roth, either that's through your employer-sponsored Roth 403b or 401k, or a personal Roth IRA, I'm sure Abby and Casey would attest, and the team here at Euclid would attest, consider increasing contributions into a Roth. That vehicle alone can be some of the best ways to play defense on taxes. And then my next brief note is the HSA box. And my note there is that once you're 65, collecting Social Security, you are auto-enrolled in Medicare Part A. And because you're in Part A, you can no longer contribute to an individual HSA. And yes, I emphasized individual on purpose because there are things called a family HSA. And I'm not saying here on the call that that is a workaround. All I'm saying is that just know 65 and older, taking your benefit, Medicare Part A, can't do an individual HSA. If you want to talk family HSA and if that possible workaround exists for you and your family, consult your team here, Casey, Abby, and the team at Euclid, and I'm sure they can understand that holistic picture. So we are on our last slide before our key takeaways here. And I want to quickly just break down the Medicare premiums. Why do we talk Medicare premiums when we talk Social Security? Well, because once you're eligible and paying that premium from Part B and Part D, that premium is actually taken off your Social Security check before it hits your bank account. So we always get those questions. Hey, I'm 65 and I'm in Social Security. Why did my benefit get reduced? When in reality, it didn't. It's just now they're paying a premium off their benefit. Okay. Quickly highlighting, I want to do two quick highlights. The bold in the bottom right, premiums are based off of your monthly adjusted gross income from 2 years prior. And this is in perpetuity, a 2-year rolling period, right? So as you can imagine, if you're 2 years post-retirement, the premiums that you're possibly paying are based off of years that you were working, right? So on higher income bracket year. There is a form out there, which you're not going to see on your screen, is called SSA-44. That is a form that you can file with Social Security to update them on your current year income so that they can reflect your premiums you're paying based on the current year, right? Post-retirement. So just know that there are only 7 reasons to file that form, but reduced work hours, death of a spouse, death from a household, or retirement are all reasons to file that form and update Social Security on your current year income instead of them using the 2 years prior when you were making all the buku bucks in the last couple of years of work, right? My next brief note on the Medicare premium is what we call the widow trap. That's a little better or easier to explain through a hypothetical. So say I make 150, my wife makes 60. That's joint 210, okay? If you look, joint 210 is at the top row, paying 185 per person. Say my wife passes away. The next year, I file individual at the same income, 150. You can see now individual 150 puts me in the 3rd row, doubling my personal premium. So it's just something we say look out for. It's unavoidable. We commonly get questions like, hey, my spouse passed away. Why did my Social Security benefits get reduced? When in reality, it didn't. It's just your tax filing status changed and now you're in a higher bracket. Okay. So again, I appreciate everyone sticking with us. This is our 5th and final key gold slide of the presentation. As I said in the start, is everything we're going to cover today going to apply to everyone on the call? No. But we want to make sure we're asking the right questions for everyone as they go to plan to take their benefit. So those questions we ask anyone, regardless of their scenario, is first, how long are you working or are you still working? For anyone planning to take their benefit before full retirement age, know that there's that limit that they can earn, that earnings limit, before benefits are withheld from them. And we often say, why is it worth turning your benefit on if you're still working just to see checks withheld from you anyway, right? Secondly, withdrawal rate. Sit down with your advisor team here at Euclid and understand those puzzle pieces, right? All those other outside factors in accounts and how those are going to come into play to take your benefit. And then lastly, life expectancy, which if you're single, this is the one we kind of care about, right? So poor family health, poor personal health, probably better to take your benefit earlier on. Whereas in the inverse, where you have good health, good family health, longevity, try your best to maximize your benefit as your other accounts and situations allow. For married couples, the reason why we traditionally don't ask life expectancy questions is because data tells us that there's a 50% chance one of the spouses are going to live until the age of 90. So our general rule of thumb for two spouses is lower earner, take whenever you want, or really take whenever you're not subjected to that earnings limit or won't be subjected to that. Secondly, the higher earner, try your best and maximize that higher earner benefit. Remember how Social Security grows as percentage based. So that's how you get more and more from Social Security is maximizing that higher benefit. That's how you're going to maximize additionally the survivor benefit and how you maximize the most over both spouses' lives from Social Security as a whole. So with that, I know I'm a continued run-on sentence. I will stop, take a sip of water. If there's any questions, we can address some. And just know that we do have a resource that Abby I sent over to you that's fully approved for everyone that you can get, and it's going to have most, if not all, the images you saw on screen in that PDF with additional context as well. So with that, Abby, I can turn it over and we can address any hard questions, if any.
Thank you, Zach. It was very informative. A lot of information, drinking through a fire hose sometimes, right?
Yep, yep.
A couple comments I wanted to make. Well, the one was about the Medicare premiums and filling out that form. That did happen to, I had to do that for my mom because my dad passed away. So in the 1 year, she got a decent payment for something. I don't even remember what it was, but put her in like the third or fourth bracket. So I filed that form and they adjusted it and gave me the premiums back, which was shocking.
Yep.
It actually didn't take long at all. I thought it would be like this long process. It was only like 3 or 4 weeks, and they adjusted it and gave me the back premium or gave her, I should say,
Right.
the premium into her account. So definitely worth looking into if you find yourself in that situation. You might as well give it a try and file.
Yeah.
Um,
And
and
again,
then
there's only 7 reasons to file that form. So for anyone that's thinking like, oh, I'm planning on selling a second home, just be on the lookout that that's not a reason to
not
change
right.
your income. So tax consequence in the year you sell that second home, but then know that the 2 years down the road, those premiums are going to reflect that sell as well. Um, so
And did you say, and I think you did, or maybe I misunderstood, the survivor benefit that you have to go to claim that in person? Is that what did you say that? Is that something they just
yes.
changed that everyone had a fit about? Or am I
So from my understanding,
failing?
that's always been the case. But I will say that they accommodate, right?
Yeah.
So you can predate a survivor claim up to, or post date, excuse me, up to 6 months. So it's not like they say, hey, your spouse passed away, you have to act right away. You can always post date or predate that survivor benefit up to 6 months. So that way, after 6 months, your spouse passed, you can then make your appointment, get in there and get all that back payment in a lump sum as well. Um, but no, from my understanding, that has been a rule. Maybe they did some changes in the current year, trying to save some money, right? Because obviously in-person appointments, they're just more costly than phone appointments from the administration's perspective. So I say right now, current rules, but it can always change, right?
Right.
And with budget cuts going on, Social Security is not, I wouldn't say not, but kind of in a spotlight of budget cuts in the current administration's view. So I could understand or see a realistic world where maybe we're going in the next year, the following year, where they make that more accessible to file online or in person. It's just with the documentation needed, they need
Yeah.
death certificate, which, typically they get reported deaths from the funeral homes as they get them. But they also have to make sure you're eligible, and because there's, divorced people that can take it off of an ex deceased spouse and all that, like they want to make sure that the paperwork is in order. And from my understanding, that's why they've always required it in person. Um, but I mention that as well because sometimes it can take 1 to 3 months to get that in-person appointment. So, but if you've heard of anything else otherwise,
I
I'd
mean, I
love to
could be
hear it.
wrong, but I am nine. Well, I know I didn't take my mom to Social Security when my dad passed away because she wouldn't have had any idea of what we were doing. So I thought it just happened when the funeral
Yeah,
home filed it. And I thought that between Medicare and Social Security, I feel like hers just kind of, maybe I'm wrong. I was brain dead then, but
I'd
Yeah,
love
I
to
know I
know
didn't take her.
otherwise,
I know I
because
did not take her in person to Social Security. That I can know. So I was just curious about that because I know there was something recently I thought that
it's
changed where
possible. I'll look
they were
into
like,
it.
you have to be in person for something, and everybody was like, "What are you talking about? Nobody can do that." But
Yeah.
anyway, does anyone have any questions for Zach or Case or me? Okay, I
And
do
if
want.
not, I have there's a common question that we usually get is around the insolvency issue, right? We always get
Yeah.
people concerned, like, how do I weed through all the news, right? Because we all know media companies make money off our clicks. So the more threatening the headline is, the more likely you are to click on it. So you're going to see, over the next 5, 6 years, a lot of headlines that say your Social Security benefits are going away, right? In reality, insolvency doesn't mean it's going to zero, right? Right
Right.
now, the estimate is about 81 cents on the dollar, and the current date is around 2034. I wouldn't expect Congress to make their opinions known about how changes are going to be made until they absolutely have to be. Because, right, as soon as they make their public opinion known, they're either going to gain half the voting demographic or lose half the voting demographic. So comb through the noise. I would pay attention to the 2028 presidential election cycle is going to kind of set the landscape of how both aisles are thinking, right? And then that 2030 congressional election cycle is really going to be those congressmen and congresswomen that are going to be writing, co-writing, or sponsoring those bills that are actually going to change the benefit picture, right? So um, that's kind of how I would comb through the noise and the scary headlines and really just pay attention to those two key cycles, because that's going to be the setup for future changes.
No. Um, yeah. The one way I always try to frame it for clients and participants that we're talking to about um, the insolvency is that it's basically, I always try to equate it. I hope I'm right in saying this. It's like your own personal income. So let's just say for years you were bringing in money and you weren't spending as much as you were bringing in, right? So you're building up your bank account and you had your bank account up to $100,000. Well, then all of a sudden you start spending more than you're bringing in. So that continues to dwindle down, which is what's happening now. Right
Right.
now, that we're bringing in less than we're sending out. So at some point, that's going to get to your bank account has nothing in it. However, you're still working and bringing in a certain amount of money. So there's always that income that you get to spend, but it's just less than you were used to spending. So it's like you might
Right.
have to cut your spending to satisfy, to equate to what you're bringing in. So that's kind of where we are with the Social Security. And at least that's the way I try to make it
Yeah.
understandable to people about what's actually going on. There won't be zero. You still have a job. You're still bringing
Right.
money
Right.
in, but you'll have to reduce your expenses, if you will.
Yeah. And because of
Um,
that, voting demographic above 50 being the largest, my expectation is they'll do everything they can to screw over my generation to make sure
right.
everyone's taken care of. And
Yeah.
then they'll kick it down the aisle, right? And make
Yeah.
sure that,
You and Casey are in trouble.
yeah,
But I know.
that's all right.
I'm like, okay.
Casey, we'll be 50 and older in 20 or so years, and then that's when our
Yeah.
opinions will matter again, right? So
Yeah, I'm 54 now, so I'm like, I know you said 50, which I do think, but I'm like, if I could get to 55, I think I'm fine before they make any decisions.
for sure. Yeah, yeah, right.
um, the other thing I just wanted to share my screen. I mentioned earlier that we are having another a Medicare seminar next week. Can you guys see that?
Coming up,
Um,
coming up. There it is. Yep.
There it is. Yeah. So, making the most of Medicare, that will be presented by another partner of ours at MFS, Graham Kimmerer. I guess how you say that,
You
Kimmerer.
got it. Yeah, you got it.
Kimmerer. But it would be the same time, 11:30 on Zoom, and we'll send an invitation. Actually, I think Casey said that's going out this afternoon. So if you, or sometime here the next day or so, so you should see that. If you're a personal client, and then we will also be sending it to the plan sponsors for people to share that
Yeah.
way.
And I can't
So
speak more highly to Graham. He is so knowledgeable. I mean, this is his focus. So I obviously, Abby, as you read my intro, I'm in sales. Graham is part of our business development team where this is literally what he does. So he travels the country. He meets with Medicare consultants all over the place. And I can tell you that the information he shares in his Medicare seminar is invaluable. So for people on the call, get your watch parties together, get the the projector out, invite your family, especially going into the new year with some of these Medicare changes that are going on. It's definitely important to be aware about where you're getting your information, and then some of those changes to know and be aware of going into future years.
Great. Well, everybody, thank you so much for joining us. We really appreciate it. And again, hopefully you can join us next week. Tell your friends, tell your family. You're welcome to join as well. Zach, thank you very much for all the
Yeah,
wonderful information. We really appreciate you taking the time to spend with us.
happy to.
Yeah.
And if anyone has a question, if you get woken up in a sweat at 2 a.m. being like, "Oh, that was my question," just get those over to Casey or Abby. They have my inbox. You guys feel free to flood my inbox, and we'll do our best if it's easy enough to reply via email. But if it involves a little probing or back and forth, we can always coordinate some time. So
Great. That sounds great. All right, everybody. Thank you so much.
thank you, everyone.
All right. Have a
Thanks,
good
Zach.
day.